Mutual fund, index fund, ETFs. What the heck is the difference? Investing in stocks is a great way to build wealth in the long run. Even when the market is down like it is right now, about 21% from recent highs. But getting started can be confusing. Gone are the days when you called a broker with a small office down on Wall Street and asked for 100 shares of General Electric. Today, there are all manner of investment vehicles known as funds that help you buy baskets of stocks or bonds all at once. The issue is there is a lot of confusion on what the heck the difference is between a mutual fund, index fund, and ETF. Well, today we're going to clearly explain the differences, and all your questions will be answered. So let's hop right in, and as always, if you found the content informational, giving us a quick thumbs up and commenting on what your favorite index is a great way to help us to continue providing you awesome videos. So let's get started. The first thing you understand is there are generic market indexes that reflect the overall performance of the entire stock market. The indexes are the Standard & Poor's 500, Dow Jones, NASDAQ Composite, and Russell 2000. All funds minus bond funds try to match the performance of one of these indexes or outperform it. So what the heck is an active mutual fund? A mutual fund is a basket of stocks, bonds, or other types of assets. It's a fund that contains a pool of different people's money all invested into different baskets of stocks, bonds, or whichever assets the fund manager has chosen. This basket is professionally managed by an investment company on behalf of investors who don't have the time, know-how, or resources to buy a diversified collection of individual securities on their own. In exchange, the fund charges a fee which may run around 1% of the amount of money you have invested annually or more. That means $100 in fees for every $10,000 you invest. Holdings are selected by a portfolio manager whose job it is to pick stocks that he or she thinks are poised to perform the best, while avoiding the clunkers. This is referred to as active management. Active management tries to outperform the average gain of the general market indexes. In comes what is known as an index fund. An index fund is also a mutual fund but managed by a fund manager passively and not actively, instead of actively picking stocks. The portfolio manager simply chooses stocks that already exist within one of the general market indexes. While the aim of an active mutual fund is to beat the performance of a market index, the aim of an index fund is to replicate the performance of that entire market. Index mutual funds are lower in cost and are passively managed. This means index funds buy and hold rather than trade in and out of stocks like an actively managed mutual fund. Because index funds buy and hold rather than trade frequently and require no detailed analysts to research companies, they are much cheaper to operate. The Schwab S&P 500 Index Fund, which you guessed it, contains stocks that only reside in the S&P 500 Index. Charges just 0.02% annually or $2 for every $10,000 you invest. When you own all the stocks that make up a market index, you'll earn just the average return of all the stocks in that market. This raises the question, who would want to settle for just average performance? The answer is tons of people, and with good reason. While it's counterintuitive, academic research has shown that the higher expenses associated with active management and the inherent difficulty of picking winning stocks consistently over long periods of time means that most funds that aim to beat the market actually end up behind in the long run. You basically end up with lower gains in most active mutual funds and paid a premium to do so. Ouch. Mutual fund researcher Morningstar regularly studies the performance of actively managed funds. Over the past 10 years, fewer than 1 in 10 actively managed blue-chip stock funds have outperformed comparable index funds, and only about 20% small company stock funds have done so. Hopefully, that clears up the similarities and differences between the two. Thanks for watching. But wait, you said, Casey, you forgot to tell us what the heck ETFs are? And you would be right. I'm just making sure you were still paying attention and gave us a thumbs up all right. So what the heck are ETFs? An ETF is a form of index fund. Broadly speaking, there are two types. On the one hand, there are traditional index mutual funds like the Vanguard 500 Index Fund. Then there are so-called exchange-traded funds, such as the SPDR S&P 500 ETF. Both will give you similar results, but they are structured somewhat differently. For starters, with a mutual fund, you often buy and sell shares directly with the fund company. The fund company will let you trade those shares once a day, based on that day's 4 p.m. closing price. ETFs, on the other hand, aren't sold directly by fund companies. Instead, they are listed on an exchange and you must have a brokerage account to buy and sell those shares. Historically, that has made ETFs more expensive for long-term investors, since you needed to pay a commission each time you want to buy or sell. In the past few years, a price war among online brokers has changed all that, with most now offering free trades for stocks and ETFs. That means ETF investors now get the convenience of buying and selling in the middle of the day at no extra cost. So does it mean you should go with an ETF over a mutual fund? There isn't a simple answer, but for my money, I'm Team ETF. For one, there are tons of different flavors of ETF funds that offer growth options, high dividend quarterly yields, monthly income dividends, specific sector-only fund, etc. Tons and tons of choices. In another video, we will discuss the top-performing dividend ETF and which ones you may want to invest in. Hopefully, this finally answers the most asked question for new and even seasoned investors. So what is your favorite investment fund? Let's share our favorites with each other in the comments below and help us all become better investors. As always, thanks for watching, and don't forget to subscribe and join our investing community.